we had the benefit at that point in time of having two forms of capital, our opportunity fund
Mhm.
and our insurance company.
Mhm.
Well, the opportunity fund has a much higher cost of capital, and there were certain transactions that we couldn't actually make sense for in that vehicle.
Mhm.
But we had an insurance company with a lower cost of capital that could go buy very high quality core product that otherwise would have gone to Odyssey funds or
Mhm.
certain open-ended core plus funds,
Mhm.
but none of them had capital.
Right.
And so we stepped in at that moment in time with the insurance company to go buy that kind of product, to have sustainable, resilient capital across the risk reward spectrum through cycles. That's a lot of monikers, but hopefully
Mhm.
that makes sense. And that's really
Yep.
what played out for us, both during COVID, 22, 23. And that, quite frankly, is one of several major benefits of being in an organization like KKR.
Hi, this is Matt Slepin, and welcome to Leading Voices in Real Estate. Today's episode is a conversation recorded on February 26th with Justin Pattner, the head of U.S. investing for KKR's real estate business. This was a broad-ranging conversation that echoes so many of the recent themes of the show, talking about global capital flows, the history and evolution of REITs versus PE versus traditional real estate investment managers, the question of operating platforms versus leverage through others, and a whole lot diving into the meaning and importance of culture within what have been such different companies on the pod. And for me, I'm always fascinated, especially as a recruiter where my job is to be a diviner about people. I'm fascinated by what I will call the innateness of these incredible people I get to talk to in business and on the show. In job interviews and on podcasts, you would think that folks are programmed to give the right answers, to tell a certain narrative, all to drive to perfect responses. I'll let you in on a secret. The goal in the job interview process and on this show is to search for that innateness. And that comes less in direct Q&A and less in traditional interview topics than in how the interviewee chooses to fill the space in the conversation. Said differently, I try to create a lot of white space in interviews, both in job interviews and on the show. And hearing how and what people choose to talk about over a longer conversation gives the real answers, which is why I don't do half-hour interviews for Leading Voices, and I never do them as a recruiter. Give it some time and air, and you get closer to the real person. That's my very time-consuming trick as a recruiter, and you've been generous as listeners to go through this approach with me on many episodes of the show. And that's what I think of when I think of this conversation with Justin. To borrow a term, we kind of did the weave through the conversation to learn about how KKR Real Estate does its business, where they play, how they differentiate. Hopefully you'll find the conversation as interesting as I did. I am off this weekend for a month-long vacation with my wife Diane to Chile and Argentina. You'll hear from me with Leading Voices interviews I'm having with Francisco Rencoret, a major developer in Chile, and then the former mayor of Buenos Aires and someone with great impact on the built environment, Horacio Rodriguez Larreta. I hope I'm saying these names right. I guess my choosing to do 2 Libra episodes while on vacation underscores another point made in today's conversation with Justin. If you love and find passion in what you do, there is less deep distinction between our work side and the human side. I am lucky with my new emeritus status at ZRG to keep advising on the people and strategic side of the business with my colleagues at ZRG and in the industry, and to continue to have these Leading Voices conversations both here and also now around the world. If you're enjoying the show, please remember to subscribe or follow on your favorite podcast app. The best way to show your appreciation for the show would be to rate the show on your podcast app. It will only take a few minutes, but it will help these conversations reach a broader audience. And the other way is to let us know how ZRG can help your business on the talent side, including search, consulting, or advisory in the real estate space. If we can be helpful, please contact me at mslepin@zrgpartners.com. I hope that you enjoy this conversation with Justin Pattner. So, Justin Pattner from KKR, welcome to Leading Voices in Real Estate. Thank you for being on the show. You're based in San Francisco, but at the moment you're in New York. I'm in the Bay Area, and we have a lot to talk about today. One comment is I want to stay high level thinking about capital flows into the business and strategy. This is not a conversation about what's hot in 2026. this is what's going to have good value over a long period of time in terms of investments. I'm curious about how capital looks at this. I'm curious about how deal flow looks in sectors. And I'm curious about, from your perch at KKR, where you want to be, how you want to do it, and what that means long-term for the value that you guys create. So really excited to have you on the show.
Wonderful. Those are, that's a broad swath of topics there.
We'll do everything we can.
Sure.
So Justin, why don't you first introduce yourself, and then we'll do a brief introduction to KKR, put this in context, and then we'll jump into it.
Sure. Well, first, Matt, really appreciate you having me. I'm excited for the conversation. So my background, I've been at KKR as of 10 days from now. It will be 15 years. I joined here with two of my partners to start the real estate investment management business in 2011. Prior to that, I had spent about, call it 7 years in different types of investment management jobs, all real estate related. So I was at Lehman Brothers in their real estate private equity business for a couple of years. I worked with Dean Adler, Leeward Adler, for a couple of years. And then I actually met my current partner, Ralph, who is the global chair of our real assets business at a hedge fund called Eaton Park, which was not real estate specific. It was a multi-strategy investment organization where I really think I learned a different style of investing.
And what is your role now at KKR? And where do you go backwards and forwards through the conversation? So I want to know some history as well as what you guys invest in your business.
Well, look, my role now is I run our U.S. real estate investing business. I have not to self-direct and going back and forth, but I've worn a lot of different hats, as you naturally would as you're starting a business over the course of the last 15 years. I like this one. I enjoy wearing it. And I hope to be wearing it for a while longer.
And if I think of KKR, which has a long history, and we'll get a little bit into that, having started real estate in the firm 15 years ago, sounds like, really, wasn't it there before? Was real estate not an investment class? And I think there was some real estate debt investing before that, because I met some guys in the Bay Area who were in the debt practice there. But so talk about that a little bit.
Yeah. So we actually are having our 50th anniversary as a firm, 50, this coming May. So KKR has been around for a long time, one of the pioneers in the corporate private equity LBO business. And that was, the bread and butter of the firm, and in many respects where it still is for a long time. As time went on, as certain asset classes became more institutionalized, as there was larger pockets of capital for private markets investing, we did launch a corporate credit business, or a credit business, in the early aughts. There was some, RMBS type of investments that we did. That is most likely what you were referring to. Several years after that, we launched an infrastructure business. And then in 2011, we launched a real estate investment management business. This all coincided, Matt, with the firm going public in 2009. And then that was in Europe, and then ultimately relisting in the United States in 2010. Implicit in that decision was to become a global diversified asset manager, partially because if you're a public company and you're a pure play PE fund, you likely are not going to trade as well when you are focused in one area. And then quite frankly, we had built a really strong business and had a lot of information, and our co-founders really believed that there was more that we could do with it, and more ways for us to serve our customers, our LPs, if we got into these different businesses.
So the first time, I didn't grow up thinking I would ever be involved with financial real estate. So this was all new to me.
Matt,
and the first time,
that makes two of us.
Okay, cool. I wanted to think about how you got into real estate, but the first time I ever heard anything about either private equity or leverage buyouts, which was what you guys were the first name out there because of the Nabisco deal and movies and all that kind of stuff. Talk about what that history and that antecedent, if that's the right word, what that means for who you are today, and then switching from the intensity of that kind of business to the very long-term focus that a long-term investment manager has.
Yeah. Well, I'm not sure that the intensity is any different.
Yeah, I bet.
In many respects, I think it's probably even more. If you want the origin story of KKR, Henry and George and Jerome Kohlberg got together to form the company, as I mentioned 50 years ago,
Hmm.
they were all working at Bear Stearns. And
Mm,
one of the big reasons that Henry and George and Jerome Kohlberg decided to leave and form their own company was the culture at Bear Stearns was much more of an eat what you kill type of
mm,
environment, which actually meant, and Henry and George tell the story all the time, that when they left their offices at night, they locked their desks, they locked their doors because they were sort of afraid that folks were going to go in and take their information and do things.
right.
And so when they launched KKR, it was under the premise of continuing to push on LBOs, but
Hmm.
doing it in an environment where they could set a culture more of collaboration and competition.
It's funny. I want to think of collaboration, competition, and even more intensity now. You almost think of those as different. You think of intensity and locking the drawers together versus intensity and collaboration together.
That's probably right because there's a negative connotation that comes with the word intensity.
Right.
The reality is you do need to be intentional around trying to partner with folks in a business that's now 4,000 people to
Right.
really work with them to really be able to share information, to be able to take information and form better views around how to spend our time, how to invest, how to business build. The only other comment I'd go back to, by the way, in terms of the origin story of KKR, um, Henry and George are entrepreneurs at heart.
Hmm.
KKR has grown a lot, but they started the firm, A, because they're entrepreneurs and they were essentially founding a new sector,
Industry.
asset class, industry,
Right.
and they also wanted to go and build their own company. And culture has always been a really important part of that. But that's really kind of where it started, how it started. And to be
Hmm.
honest, as much as we've changed, to use your words, more long dated asset manager, um, you know, the focus and the ethos of the firm, much of it has stayed intact. We could talk
Mm.
about how that has been done,
Hmm.
and how it continues to essentially evolve, but it's still there.
Cool. So we could go down the rabbit hole and spend a lot more time on that, but let's move on to putting real estate in context of this. So you guys came over de novo to set up a real estate platform, actually, as the real estate business was also then changing. So what was the vision? How's that turned out? And how does that fit into KKR? So I want to kind of follow each of those from a big picture standpoint.
So going back to the mindset of Henry and George as entrepreneurs, what an
Hmm.
entrepreneur typically does is they identify an opportunity, and they determine if they think they should build a business around it.
Hmm.
And that opportunity, by the way, could be based on a need. It could be based on something else. So if you rewind the clock, go back to the GFC, 2008, 2009,
Hmm.
2010, there was a decent amount of washout in the real estate investment management space. And a lot of, not a lot, but certainly more than a handful of the larger incumbent, largely bank sponsored real estate investment managers were dealing with a lot of problems. Some of them shuttered their businesses. Others just took a long time to build out.
Hmm.
And that happened to coincide with the moment in time where the alternative asset managers were growing.
Hmm.
And there was a need that they felt like they could fill for institutional investors. And that was really what we were looking to address. And so when we came over here, the mandate from Henry and George was actually, in many respects, very straightforward, and
Hmm.
in many respects, like very open ended. Again, entrepreneurs. It was to build a real estate investment management business that mattered, and to do that with companies and individuals that were of the highest integrity,
Hmm.
both from a co-branding perspective, but also from the perspective of their view was it's really hard to build a business that matters if you're dealing with challenging people and challenging companies, because that will be a massive distraction.
Hmm. It's funny as you tell that story. I think out of the S&L crisis, out of the RTC, came the first generation of opportunity funds in real estate and the first generation of, or second generation of REITs. And they then dominated for the next cycle. But out of the GFC really came private equity, in some ways eclipsing both the REITs and the traditional real estate investment managers. And somewhere in there is where you get to play and have built this business
But you're 100% right. The first wave of opportunity funds were born out of the RTC, where, individuals and then ultimately organizations put capital together and, capitalized on what was going on with the savings and loans. And to be frank, at least from studying the space for now over 20 years, that the models that were built to pursue that type of opportunistic investing really worked for 2+ decades.
Mhm.
Um, and, that has had to evolve as the industry has matured, but definitely agree with what you said.
And something that's in there is at that time it was buy really well, sell really well in a market that's recovering. But out of the GFC, I think it was buy well, hold well, operate well, and then maybe sell. I think it's a different thing, right?
Yeah, well, it's interesting. I think about the RTC as an opportunity to buy. Markets were very inefficient for a lot of reasons. A, they weren't as institutionalized. Most of the institutional players at that moment in time, as you know just as well as I do, were insurance companies, and organizations like that. It was not looked at as a higher returning asset class for the most part.
Mhm.
And in the RTC, you just had a flood of product that, needed to be moved. And if you had capital and the right relationships, you could go pick those assets up at very, very cheap levels. Sometimes you needed to fix them to move them. Sometimes you just picked them up, the market healed and you moved it. I would tell you, obviously the world evolved, but if you fast forward to 2010, 2011 and beyond, yeah, the space changed a tremendous amount. So when we first started, and please interject if I'm going too far down a certain path, and Henry and George said, go build an investment management business that mattered, we sort of surveyed the landscape.
Mhm.
And um, most of the real estate private equity players had one strategy, and that was closed end opportunity funds. Most of them were deploying a model that had worked very well, off of which they built very impressive businesses for a long time, which was going out, leveraging networks that they had created over the course of several decades to find idiosyncratic deal flow. So opportunistic hunting and partnering with third party operators in joint venture format to go run those assets for them. That was the business.
Mhm.
Um, and by the way, that's the business that we tried to replicate for the first 2 or 3 years and quickly came to realize that we were fine at it, but trying to go and win at a game that your competitors were playing for 20, 25 years wasn't going to help us get to a place where we were building again, a real estate investment management business that matters.
Mhm.
So we could talk about how it all played out, but when you fast forward from 2010, 2011, again, where the world was made up predominantly of a model of pure play opportunistic drawdown funds where you're partnering with third party operators to where we are today. You have multiple different strategies that these organizations uphold just on the investing side. Put credit to the lending to the side for a second. Closed end opportunity funds, open ended core plus vehicles, retail channel, insurance. And so it's a totally different business from that perspective. And then layer on top of that, and again, in the 11 timeframe, you had this interesting dynamic where many operators were trying to disintermediate allocators, private equity
Mhm.
funds. And you had certain private equity funds that were trying to get around the construct of paying double promotes and controlling their own destiny. Again, we can get into it, but that's led to meaningful amounts of change over the course of the last decade or so.
Uh-huh. And I want to think about what your business looks like now, where it's going. And we're talking really good and very helpful context and history here. And it's interesting that you said, hey, difference is less what you're moving away from double promote, um, allocator model. And also, you're moving away from only closed end fund to multiple different vehicles. And maybe you wind up operating this yourself by cutting out that middleman because you're building opco platforms. One story I'll tell that fits this is I remember when, I hate to use their name, but when Blackstone bought a bunch of single family residential to do Invitation Homes, the question in the world was, are they doing this to flip it? And they said, no, we're buying all this to build it because we're going to build an operating platform around this business that will be perpetual. But everyone suspected they were just doing the disallocation of the buy, but that wasn't the case. And that was a big transformational moment, I think, that's reflective of what we're talking about here, using someone else as an example. But talk about the different vehicles that you have, time horizons, and how those vehicles play together within, and how much AUM, what's the size of your business now, and what are the different vehicle longevities and strategies within the size of what your business is today.
Sure.
And we'll talk about where it's going later.
Um, so to answer your question directly, so today, the way we think about it, we try to simplify it. We have our flagship in strategy, which is our closed-end opportunistic strategy.
Mhm,
As you know, my purview is the US. What I'm saying, at least from this perspective, also applies to Europe and Asia. That strategy now has been around for 15 years. That was the first
mhm,
one that we launched. As time went on, we realized the value that we could deliver to our customers by being in the core plus business
mhm,
and institutions, but also the value that that would create for the benefit of both our core plus investors as well as our opportunistic investors. And what I mean by that is the following. Um, as you know, transaction markets are not bifurcated or organized based on cost of capital.
mhm,
They're organized based on sector and geography. So the same broker or banker that's selling an office building that's a lease up play in Manhattan is likely the same guy that's selling a stabilized building. And so our view was, hey, we're actually in a pretty interesting position to be able to assess risk reward because we're playing in the opportunistic space. We're seeing all this other flow and we can price that in a more informed way because we're in the opportunistic business.
mhm,
Then we got to thinking, we're like, well, not only can we make better risk reward decisions, but by having capital that can invest in both areas, we actually become a more important counterparty to the intermediaries. And by the way, we didn't go into that, but when we first started the business, the guys will never tell you this. It was a very, very humbling to break in with a lot of the intermediaries, a lot of the operators, a lot of the talent, because while KKR had been around for a long time, nobody knew us in real estate.
mhm,
Going back to it, because we had capital in both areas, or the thought was if we did, we could be more important, see better flow. Third was um, being able to transact in both areas also meant more assets,
mhm,
better decisions. And then finally, because we were building these operating platforms, more scale for those platforms. Why is scale important in those platforms? Because more scale means better people. Like anybody else, if you're an operator and you start out as a assistant property manager, you want to be able to become a property manager. For a property manager, you might want to become the head of leasing. Well, that
mhm,
only works if you have a portfolio or if you're in a company where you can continue to grow with that company. So
mhm,
more scale meant better people, better systems, better processes, better data. That's what took us in that direction. So it started out with institutional core plus. And then as a firm, we keep on evolving. We should come back to that too, because I think a lot of people think about all the different global asset managers, large cap global asset managers as being very similar. We're actually all very, very different in terms of our strategies, but we bought an insurance company in 2020. That's been a great source of capital for us as well. That's complementary to what we do in the institutional core plus space. So by example, most of the open-ended institutional core funds, as you know, as the market knows, were not able to raise capital when rates corrected and values corrected. So you had a dearth of that. Well, we were able to step in 2023 and 2024 with our insurance company that had a lower cost of capital than our opportunity funds to take
mhm,
advantage of massive illiquidity constraints. Again, complementary to our open-ended core business. And then this is an area that that we have a vehicle in, but we have not, sufficiently scaled it, but we'll continue to grow it. That's the non-traded retail channels that are
mhm.
obviously evolving in a very meaningful way, have evolved in a meaningful way over the last 15 years, and should continue to as, you know, um, more and more progress is made around defined contribution and 401k, et cetera.
Mhm. Hey, when you say that the insurance company has lower cost capital, therefore they can provide liquidity to that other business, either that means, I'm going to use funny words here, that means they get the schlock, but I don't think that's the case because I think it's lower cost of capital because they have a longer time horizon to look at it and therefore less volatility to how they look at it over a longer period of time. So it's not trading them dregs or schlock. It's actually just allocating correctly longevity of capital and risk premium. Is that
Yeah,
kind of right?
let me clarify. Um, there's no world where any one of our vehicles that we control lends to, buys from, provides liquidity to another one.
Okay.
That was like a pre-GFC like learning lesson where you had a lot of these
Uh-huh.
organizations that would lend to themselves on deals they were buying, and it created all sorts of conflicts, and it really did not end well. So um, when we started the business here, we had the benefit of de novo platform, having studied the space and been active in it for a long time, and just setting certain parameters around things that we would never do. So that's
Mhm.
one of those things. The point I was trying to make actually was a little bit different, which
Okay.
is we have sort of a core plus umbrella under which we have an open-ended institutional core fund. We have an insurance company, and then we have a sort of smaller 1940 Act vehicle, non-trader REIT. I put that
Mhm.
one to the side a little bit because the strategy there and what we target is a bit different. So just focus on the insurance company for simplification and the
Mhm.
open-ended core plus vehicle.
Mhm.
The point I was actually making was um, when it was hard to get capital flows into the open-ended vehicle, second half of 2022, really through the end of 24,
Mhm.
because of where values had gone and because of the way those vehicles are marked. You had a massive exodus of capital in the market,
Mhm.
right? Core funds couldn't invest, core plus funds couldn't invest. We had the benefit at that point in time of having two forms of capital, our opportunity fund and
Mhm.
our insurance company.
Mhm.
Well, the opportunity fund has a much higher cost of capital, and there were certain transactions that we couldn't actually make sense for in that vehicle.
Mhm.
But we had an insurance company with a lower cost of capital that could go buy very high quality core product that otherwise would have gone to Odyssey funds or
Mhm.
certain open-ended core plus funds,
Mhm.
but none of them had capital.
Right.
And so we stepped in at that moment in time with the insurance company to go buy that kind of product, to have sustainable, resilient capital across the risk reward spectrum through cycles. That's a lot of monikers, but hopefully
Mhm.
that makes sense. And that's really
Yep.
what played out for us, boy, both during COVID, 22, 23. And that, quite frankly, is sort of several major benefits of being in an organization like KKR.
So I want to ask a question about how much US versus how much global and how that allocation
Yeah.
works. I want to talk about operating platforms and scale and what that means within this. But first, you said we missed a core important founding point, I think.
Yes.
What
So,
was that?
yeah. So when we started, as I referenced, um, we were trying to figure out what our competitive advantage was because it was not obviously having been in the industry active as KKR real estate investors for
Yeah.
40 years. We knew that, that at least one, if not all, of the advantage was going to be being part of KKR. We just didn't know exactly what that meant. So let me just take you back to the origin story of KKR and the comment I made about culture. When Henry and George started KKR, the culture was meant to be collaborative, and it was. That meant the same thing, but looked a little bit different when we were just a pure play US based LBO shop. When we expanded, because the first expansion we did, when we expanded to becoming a global LBO shop, Henry and George were very much focused on making sure there was sharing of information. And so if you were an individual in Europe investing a European PE fund, or you were an investor in the United States investing a US PE fund, you shared some level of economics. Why? If you're economically incentivized and culturally incentivized to work together, you're going to share information and outcomes should be better.
Mhm.
Fast forward to, really building a investment manager with multiple different products, infrastructure, corporate credit, real estate, private equity, you know, large cap private equity growth, you name it. How do you make sure that those folks are sharing information? And by the way, when you think about real estate and the benefits of actually sharing information on the real economy,
Mhm.
starting with consumer behavior, corporate preferences, and demographics, if you can harness that, because real estate is a laggard, then you can
Right.
create real differentiation. So when when the firm decided to go public and ultimately become a multi-strat asset manager, it just heightened the importance of this collaborative culture. And so if you work in real estate, a significant portion of your economics, your incentive economics come from real estate. But by the way, a significant portion also come from infrastructure, credit, private equity, and vice versa, right? So we all share in the economics of each other's businesses, and we all share in the economics of the firm. On top of that, I live in the Bay Area, as you mentioned. I was actually asked, quote unquote, asked to move out there a decade ago because we had about 40% of our private markets investing professionals lived out there.
Mm-hmm.
And George really felt like it was important for us to establish real personal relationships to further push that collaboration. So why do I frame it that way? We learned a couple of years in was um, the encouragement to share information was a massive advantage. At the time, most real estate investors were opportunistic. You would go hunt for deals, leveraging your networks, and you'd find something idiosyncratic and you liked it. Or maybe you focused on the top 5 cities in the world. Don't know. That didn't work well for us. So I'll give you a little story and then I'll finish the point.
Uh-huh.
We owned a couple of malls, enclosed malls. And in 2013, we got a phone call from our partner, Nate Taylor, who at the time ran our consumer retail private equity vertical. And he had stepped out of a board meeting for a company that we owned called Academy Sports. And he said, look, we just spent several hours in that board meeting talking about how we were selling more product on the internet. He didn't use the term e-commerce because in 2013, that wasn't a thing.
Right.
Than at bricks and mortar stores. I know you own a few malls. He knew that because of the way we were set up. You might want to think about it. We turned around, we sold our malls. We made a solid return on an absolute basis, on a relative basis. It was unbelievable. And then we started thinking, wait, if consumers are buying more off the internet, what does that mean? How do we actually play on offense? So the aha moment for us was, wow, we can harness information again around consumer preferences, corporate behavior, and demos based on the connectivity with the rest of the firm and become top-down thematic. And that was one observation that's very unique to our organization. While we're not the only real estate investment manager that sits inside of a larger global asset management organization, we are the only ones that are incentivized economically and arguably culturally to share the way I just described. So that became one big tenet of our investing strategy. The other was becoming a hybrid investor and operator, because we just got sort of tired trying to convince these, very good independent third-party operators to do business with us, to shake them loose from their long-term incumbent relationships. That all happened in the 2013, 2014 time.
Fair deal. So let's keep going. And it's so much fun to talk about each of these and how the threads fit together. And I want to think about the operating platforms now within this context, and leading and running these businesses yourself, having them in-house. And it's a different perspective and clock speed and attention span to run an operating business than it is to do deals or investment allocations. So talk about what these different platforms are and maybe which ones you've made the biggest bets in building out the platforms on. That'll get into allocations as well, obviously.
Yeah. Let me think about the right way to frame this. So it takes a lot of time, energy, and effort to build these businesses, to grow the businesses, to improve the businesses, to evolve the businesses. And you have to be committed to doing all of those things in order for it to actually be worth it to have these operating platforms, which means you need to feel fairly convicted that you're doing it in sectors, for the most part, that are large and resilient, with some type of secular, demand trend.
Secular meaning you're going to be here for a while.
Meaning you're going to be here for a while. But the other complexity is, you never want to confuse what your customers are asking you to do. Our customers are asking us to invest money on their behalf to generate consistent top quartile performance. Full stop, end of story. It's our decision to build these operating platforms because we believe that will help us do that. But you don't want to be constrained about selling assets, not selling assets, doing things that would divert from, again, the mission that I just mentioned. How do you do that? How do you do that and also build businesses that are scaled enough where they're actually differentiated and high quality because they could support the right types of talents and processes?
Yep. And they're somewhat conflicting because if you have an asset, if you have too many of the assets that you want to sell, because it's a great time cyclically to go, okay, hey, our bet here can really pay off now, then maybe you're giving away the opco as well at the same time. Or if you're holding on to the opco, you go, oh my God, I need scale. I can't go below a certain sky, and then it's not going to work anymore.
Yeah. So I'll give you I'll just sort of take you through this. When we first started building the operating platforms, I remember talking to some of my friends in the industry who were at very esteemed real estate investment management organizations that had really good operating partner networks. And when I raised it, they would say to me, "You're crazy." I mean, why am I crazy? Well, you're never going to see deal flow from the best operators. Or how are you going to scale? Or all the questions that you would think.
Mhm.
To be honest, by the way, like we didn't have all the answers. We knew two things. We weren't seeing deal flow from the best operators because we hadn't been around for that long. Two, we also knew that the industry was changing. And we weren't looking in the rearview mirror because we didn't have an asset base, we didn't have operators. We just knew that capital was evolving and there was, in our minds, a better way to do it. That's all we knew. We were an organization, by the way, that had tremendous amounts of resources. So we have uh, an operating arm called KKR Capstone, where these are, operators, consultants, et cetera, that either ran businesses or advised on businesses. So we had things that we can pull on. And the general premise was we could go hand select the talent. We could make sure that the individuals in the organizations that we thought were of the highest quality were focused on our assets. We could control the investing strategy. If you want to go and aggregate in these 9 markets, you can do it. If you want to go by scale, you can do it. If you want to go by a company, you can do it. You can do all those things without having to rely upon an operator that might shop you or whatever else. And obviously the economic proposition. So we started doing it. By the first platform we ever built was in the student housing space. 3 people. Today that company is 500 people. And we started doing it by investing in individual assets. We built our first portfolio. We started taking on some third-party business. We have a property manager there. And when we sold the portfolio, we were willing to sell it as a company. We were also willing to sell individual assets unencumbered. We were willing to sell the portfolio unencumbered. And we ran a process. And it wasn't a huge deal. It's probably $800 million. So not small, not huge. The best bids came from institutional core funds, right? So we try to buy something, fix it up, do whatever it is, opportunistic cost of capital. And if you do it well, you can sort of sell to core. Neither group wanted to buy the company. But both of them wanted to keep the manager on to run the assets.
Manager at the properties, not the company.
They wanted to keep university partners on to run the assets. It was a little bit of an aha moment for us for a couple of reasons. One, all you hear real estate private equity guys talk about is building platforms and buying companies. That's what we want to do. How do you do that? Well, the reality is the deepest part of the capital markets, the deepest part of the property capital markets are individuals or institutions that want to buy property. They don't necessarily want to buy companies. And so give the people what they want and you'll get the best price. That was sort of aha moment. Sounds silly, but it was. 2 was we sort of looked at ourselves and said, wow, we built a company that these real institutions want to utilize to manage their assets. And hey, by the way, by keeping these assets, we can keep our best people. We can keep all of our people. We can continue to grow. We can hire high quality individuals. We can improve our processes. We've got better data. So fast forward, that 3-person business today is a 500-person business. 70 people are corporate or whatever, the rest are the properties. The management team is constituted of, like high-powered REIT executives, right? So the CEO has been in place for a long time. He's an amazing human being. We just brought on a gentleman who was very, very senior at UDR to become our COO. We took a gentleman over here from KKR that worked with us for about a decade. His name is Brian Cam, and he went down to the platform. And so you can really create these things that are special. Now, what enabled us to do that? Part of it was just some vision around trying to maintain scale, having third-party management, having different pools of capital. Therefore, we can buy and sell when we want it to without worrying about shrinking the organization, growing the organization, you name it. And then, the longer dated pools of capital have been helpful there as well.
Let me ask a couple of others, and then we're going to move on because there's too much to drill down on and too much on the breathways to talk about it. But I'm curious about this. One of the things you said before is real estate is cyclical, and that is true. But within that cyclicality, there's asset classes that have further cycles, some of which go away and we don't care about anymore, some of which come into this. And then let's play with student housing for that for a moment, because you're making that bet on that for a longer term period. You may wind up selling the whole kit and caboodle, which you're probably willing to do because you've created value in the opco versus the properties. And then as I think about you, how much of your time as head of the US winds up being around the opcos versus on deal flow side? Like how much of your engagement winds up being to lead those kinds of things? That's a lot of questions at once,
Yeah.
but
Let me answer the first question, which if I'm paraphrasing is, given the cyclicality of the asset class in certain sectors, how do you think about building and maintaining these operating platforms? The answer is, um, we are we don't have operating platforms in every asset class. We don't have an
Mhm.
office platform, a life science platform, we don't have a cold storage platform, those types of things. There are certain areas that we are going to be more tactical around when the opportunity is there that we're not necessarily going to be in long term. And there are people that are great that do it. There are other sectors, industrial, conventional rental housing, that probably comprise 50 to 60% of annual deal volume in the US, where we might not be interested in our opportunity fund at the moment, but we probably might be in one of our core vehicles or vice versa. First is we're intentional around where we're building this capability. Second, we've gotten smarter at this just with experience over the last decade. There are certain platforms that that actually sit under the same umbrella. So our student platform, our conventional multi-platform, they sit under the same umbrella. They have certain resources that are shared.
2/3 overlap. Yeah.
And so what does that mean? Well, we might toggle off activity in student, but the platform is being supported by, or the individuals are being supported by some of the activity in the conventional side.
Mhm.
Another way we do it is, like I said to you before, in areas where we actually have property management, we don't just operate on our own account. We operate on behalf of other capital managed by other organizations or individuals.
Mhm.
So there are a lot of different ways that we've learned over time to actually figure out how to run these businesses through cycle. As long
Mhm.
as you go back to the first point of what asset classes do you feel like you need to be in, where you need to be great, where you need to differentiate on a consistent basis versus asset classes that you're maybe being a little more opportunistic and tactical around depending upon dips in the environment.
And one other question on this, and then we should move on. But I keep saying one more. But one more in this specific asset class, there's currently no public players in the student housing business. We're doing some search work in this space, so we think about this a lot. Talk about the PE advantage or disadvantage. I don't know if it's right versus where the REITs get to play right now, say in multifamily and in student housing, and the mispricing or the strength of the capital side and structure for you versus the capital and structure for REITs right now?
For reasons. You're sector agnostic, you mean?
Well, student housing and multifamily, it may fit, but
Yeah.
in most sectors right now, REITs are underpriced
Yeah. So
and
look, yeah,
underplaying. So,
you're right. If you look at conventional housing, you look at a bunch of even like the essential sort of strip retail folks, et cetera, they're trading at pretty meaningful discounts to NAV.
which gives you great opportunity for lots of interesting things.
As you and I both know, in most of these sectors, more often than not, they do tend to trade at discounts to NAV, but those discounts are much greater than they typically are. There are other sectors, though, like senior housing, where the REITs are trading at meaningful premiums to NAV, and the question is who's right and who's wrong. Um, um, and these things ebb and flow.
Mhm.
So I would say, let's just take two examples. Take senior housing, and we'll compare it to conventional multifamily, because to your point, there's no student housing public companies. I think that the senior housing REITs, and we've felt this way now for a long time, I think the public REITs are out ahead of the private markets in terms of valuations. In other words, I
Uh-huh.
think private market values are going to go up. And the reason why, when you think about what happened during COVID to the
Mhm.
senior housing space, fundamentals really fell meaningfully. And there are a lot of private market players that had gotten into the sector in 17 and 18 for their first foray, and it didn't end well for most folks. Usually when something like that happens, it takes some time to develop the conviction to get back in if you think it's interesting. In the public markets, they also dipped during COVID. But when management teams in the public markets started observing in their senior housing portfolios double-digit NOI growth, and they started putting that out there in their projections, public markets investors who didn't have the same experience came in. And that compressed cap rates and elevated pricing for the public companies. You're now starting to see this lag effect in the private markets where they're starting to compress. I think it's moving that direction. Conventional multifamily, I actually think it's a little
Hey,
bit.
go back for a sec. Just one interesting comment. Deb Cafaro from Ventas was on the podcast a couple months ago when she was talking about how student housing is doing really well and how their investments are going well and they're transacting. And in the middle of the conversation, I said, so how much of those transactions are new build versus acquisitions? 0 on the new build side.
Yeah.
It was still, it still doesn't pencil. And that was surprising to me, given the ebullience of the conversation otherwise.
Yeah. Look, the three observations around the senior housing space going back to like 23 were the silver wave was finally here. Census data, just under 5% projected population growth CAGR for that 80-plus-year-old cohort for the next 7 to 10 years. That's pretty unbelievable relative to national population growth at sub 1. Second piece was no supply. No supply because when capital was free in 21 and 22, that sector was really struggling. And as you know, as Deb knows, it takes a long time to get those pipelines up and going. And then third, it's the dynamic I just described, which was private market, capital markets were in complete disarray. Sort of a perfect storm if you believe that the fundamentals are going to turn around. So that's what's happened, but you're still not quite, in most markets, back at a place where development makes sense because assets, again, this is starting to change in certain markets, because the coastal markets where it's harder to build are trading at a discount to replacement. You're asking about the public markets and how that impacts us. Look, so when the public groups have a meaningfully lower cost of capital and they can go and issue equity and grow, that creates obviously more competition. Then you kind of look at other sectors, like look at, the multifamily REITs that are trading well wide of private capital markets. The question is, are they right? Are they wrong? Who's right? Who's wrong? Maybe it's somewhere in the middle. I tend to think that the multifamily REITs are relatively cheap right now. And so I actually think that you could argue they're behind the private markets and ultimately at some point in time should rally based on where things are. So I said it to you because I think it's hard to paint a broad brush across sectors. I think that's always been the case. I think that's more pronounced today than it ever has been before.
And is it more pronounced in that opportunity sits in the adjacent niches versus in the mainstream food groups?
So
is there alpha there versus in the mainstreams?
So a few things. I think the reason why we've seen so much more dispersion has nothing to do with niche versus like main four. I think it has to do with the way consumers have been changing their behaviors. So think back to what happened with a lot of the sort of larger format bricks and mortar retail to corporate behavior around office space, by both these things being somewhat disrupted by technology, right? To therefore capital sort of cycling out of those asset classes, big asset classes, the biggest asset classes, and needing a place to go. And then it's where to go. It went into niches, it went into apartments, it went into industrial. And then what happened obviously was COVID. And when COVID happened, you had some demand bumps around media, demand for studio space, life sciences, cold storage. And there was a supply side response because you had these demand bumps that were now in retrospect somewhat artificial. You had capital flowing out of the main food groups, needing a place to go. So it pushed up values. So you had rents going up, values went up, development happened. So I think a lot of the dispersion, part of it is just technology and technological disruption. And part of it is just some of the impacts that happened as a result of COVID.
And in multifamily, was it there was too much building there was too much advantage of rent increases before the GFC, before COVID. And because the other side of multifamily is they spent a lot of money on differentiated operating platforms, which we just spent a lot of time talking about. And I don't know that they've been paid for that. I have loved the operating platforms that were created. I'm a multifamily guy, so I think about this. I love those platforms, but has it made a difference in how they're valued?
The REITs. Yeah. Look, the large publicly traded multifamily REITs have sophisticated operating platforms that I do believe are differentiated. They have obviously scaled asset bases, most of which are concentrated within specific regions, therefore a lot of excellent data. To be very clear, multifamily has softened, but it has obviously been nowhere close to has impacted as some of those other asset classes that I mentioned, where you saw massive dispersion in performance.
Fair deal. Okay, let's change subject. I want to think globally about the allocation now to your part of the business within your within KKR's real estate business, and how much of it is US.
So to answer your first question, we run about $85 billion of AUM. Of that 85 billion of AUM, 75% of it's in the US. Between our equity business, our direct lending business, and our CMBS securities business, we touch or control about $230 billion of real estate in the United States. That number compares to, I don't know, 30 or so billion in Asia and Europe. So our US business is meaningfully larger than
Yeah.
our Asian European businesses. Um, our Asia business, by the way, is particularly in Japan, is quite large on a relative basis
hmm
compared to the competition. Um, Europe is a little bit smaller. That's a market that's, in a lot of respects, sort of harder to grow and scale in our experience. Yes, ebbs and flows, normal, always happens. There are moments in time where you might get more capital coming out of, for example, Korea, because
Right.
there's a carry trade on currency. Then at other times where, again, like the dollar is strong, it doesn't make a lot of sense. But in those moments of time, you might be getting more money out of the Middle East, right? So I would say the capital flows have been diverse, but they're increasing right now versus the last, quite frankly, 6 months, 12 months, 18-month period of time in a
Mhm.
pretty meaningful way. Um, and, yeah, there are certain parts of the world where there's less capital to get, but it's not necessarily specific to or even related to some of the geopolitical issues I think that you're referring to.
Okay,
Well,
fair deal. It's interesting. My next podcast this is with a guy named Francisco Rencoret, who's the one larger developers in Chile, and we're going to be talking about how they get capital into Latin America, which is just fascinating. Okay, we've had a long conversation. We've talked about sectors, and you talked about niche sectors, and somehow the word data center did not come across in this conversation yet. So I have to ask: is that a space in which you're playing, and how so?
it is a space that we're playing in. I think our approach has been a little bit different, both in terms of how we got to it and what we're doing. So let me just give you a little bit of context here and then how we got in. For a long time, pre 2021, we studied the sector. And for, I think, similar reasons to many of our um, contemporaries, had issues getting our heads around obsolescence and just some of the unique fundamentals in the space, negative mark to markets, things along those lines. And what actually catalyzed our buying a company called Cyrus One um, was actually an interesting collaboration, informal collaboration across three different business units at KKR: real estate, tech, PE, and infrastructure. So go
hmm
back to 2020, and we were on the private equity side evaluating a convertible preferred equity investment into a company called Box. And around that, we did a tremendous amount of work. When I say we, my partner, John Park, who runs that vertical for us, around cloud storage, growth of cloud storage, et cetera. Uh, Around that same time, we got a call from John Kilroy to buy a large office building that was leased to Dropbox. It's actually built as a life science asset, but leased to Dropbox. In Mission Bay. And naturally, I called up John to ask him what he knew about Dropbox and, cloud storage. And he's like, well, I happen to know a lot, gave us the confidence. And it was a lot of that work around cloud storage that got our partners on the infrastructure side, or helped influence our partners on the infrastructure side, um, to really develop the conviction to lead an investment in Cyrus One, which today and certainly at the time was one of the largest data center owner, operator, developers in the world. And that deal, when we took it private, was a partnership between infrastructure, core private equity, and real estate. Each one
Goes
of
back to the conversation, the point you made half an hour ago about the partnership within the firm. So that's awesome.
and we all played different roles. Our infrastructure team led the deal. Their knowledge of power, the power grid, that company, et cetera, was far surpassed ours. Our knowledge of asset-backed finance and lease structures, et cetera, far surpassed theirs. And so it was and it has been a great partnership. In the US, after making that investment, which was predicated really on growth of cloud storage, not AI,
Mhm.
we have sort of invested more into the business and done development, et cetera. Certainly opportunity there over the medium term. We've been, I would say, a lot more balanced around the sector over the course of the last, like I said, 12 to 24 months.
Okay, I want to change subject again, and then we're going to wrap up in a few minutes. And at ZRG, we had our annual conference about a month and a half ago, and the head of HR from one of your competitors was in the room and giving a talk. He was on a panel, and one of the things that he talked about, which I found just fascinating, he came in as a change agent in the HR space. I don't think that particular company has the tradition of partnership and collaboration that you've described. And he said that one thing they've done is they've massively humanized the company. And he talked about a lot of the hiring, including in New York, was it used to be the headline was mathematics and maybe deal flow. And then now the headlines become more humanities and being able to deal with other people and more broad thinking than that. Maybe you're already there, but any comments on that, particularly for the kind of business that you have become that you've described?
Yeah. It's surprising to me that a company could exist that long without having either leadership or mid-level management that didn't possess both strong analytical skills as well as EQ and leadership skills.
Hmm.
Um, we sort of think about a baseline understanding of analytics as a sort of table stakes.
Hmm.
And these other skills that you need to do the things that we all do are critical. George Roberts uh, always reminds me of this. There are sort of several different types of profiles on the investing side at KKR. You have analysts. We have a lot of those. Again, table stakes. We have deal makers. So if you're going to be a deal maker, you absolutely need to know how to read a room and read people. We have investors. So where is the puck going? And now we have business and enterprise leaders, right? Which you need.
Hmm.
So I would say, as an organization, we are focused on, and this is our 360 reviews at the end of the year: leadership, management, culture, commercial output. Those three: leadership, management, commercial
Hmm.
productivity, culture. And that's how we evaluate our people.
It's got to be. And it's different than what we might have expected to have talked about before. But within that, and this was back to the very beginning of this conversation, you said intensity hasn't changed. And so the thing I want to think about with you for a moment before we wrap up, and I ask my very last question, but is think about intensity for you and your team and think of that alongside the breadth of perspective and being at 10,000 feet that we've talked about through this, because we've talked about lots of sectors and lots of dynamics in the capital markets and the operating markets. So you always have to be smart, thoughtful at a big picture level to always be thinking about all those things at the same time. I am so impressed by that from you and from other folks in your kind of role when we have these conversations versus someone who knows the hell out of multifamily, someone who knows the hell out of data centers or whatever. But the breadth is just extraordinary, but breadth alongside intensity is a big deal.
Look, I appreciate you saying that. I find it all to be impressive. The individual that is a master of his or her own trade,
Yeah.
whatever that might be, however broad, however deep. Um, I just think that we all sort of self-select into what interests us. Uh,
Mhm.
and, that might mean something different for me than for you than for anybody else. But I think it's all impressive. But I also think it all takes commitment and some level of intensity. And how that intensity shows is also incredibly important.
Yeah. I it's interesting, and I always think of like a muscle being engaged. Have your muscle engaged all the time. No muscle wants to relax sometimes. Hence my month-long vacation. But
I think that, uh, like anything else, as um, as the market evolves and the economy evolves, so too does a business. It has to. No different than as an individual evolves over the course of their life and their career, you need to approach things differently. You approach things differently
right.
when you're 40 than when you're 20 because your body can do different things. You approach things differently if you're married versus when you're single, if you've got kids or if you don't. And
Right.
so it's all, I think, requires a tremendous amount of intentionality and understanding kind of what your limits are and knowing how to create the right amounts of balance. Otherwise, to your
Yeah.
point, the muscle gets really tired and that leads to burnout and bad things.
Well, and to accomplish what we talked about at the beginning of the conversations, you have to be in the top 20% quartile all the time, or else you're not there, or your company's not doing what it's intending to do. Intensity comes into that equation in a very big way, and the ability to maintain that intensity as a company and as a person are differentiating factors. Just saying.
So one of the things I always say to Michael, who I love, was it's really important to learn how to work smart,
Mhm.
not just working hard. Working smarter is way more important than working harder. And if
Mm,
you can figure that out, you're still intense, but it's much more sustainable.
yeah. And also somewhere in all of this business that we do over a long period of time, there's we don't use this word, it's gonna sound silly, but there's joy, there's relationships that matter, there's depth and pleasure in this, which I think gets to the point you're making.
So, one of the things I think about a lot and I talk to folks about a lot is we are all very fortunate to be able to wake up every day and choose to do what we do.
Yep.
Oftentimes, people lose perspective around that, but
Mhm.
we go around the moon one time and find the things that make you happy. Find the career that makes you happy. What makes me happy might not make you happy, but if I enjoy what I do every day, and yes, there's an element of all the different things that you mentioned that I really like, then it doesn't always feel like work.
I will echo that 100%. Okay, that fits to our last question on leading voices, which is your advice to a young person getting into the real estate business.
The real estate business and the real estate sector is massive,
Mhm.
is multifaceted, and there are a lot of different ways to participate in the industry. So try a few different things, understand which part of it speaks to you, and then make an informed decision to go after that. Ask a tremendous amount of questions along the way because nobody expects that you know everything. And if you're an investor, one of the keys to success is acknowledging what you don't know and figuring out ways to learn what it is that you don't know or surround yourself with people that know something different. That would be my advice.
Really well said. It's interesting. I talk to people about this all the time because they think that the choice might be around which sector or which part of the industry. And as a headhunter, I always say also think about the role that fits you because the role in each of those places are really different, or the number of roles and the role that's going to fit the person. So this is wonderful. Thank you very much. I really appreciate having you on the show. It's a great conversation. I hope that you enjoyed today's episode. Please remember, if you're enjoying Leading Voices, to share an episode with a friend or get them to subscribe. If they're podcast wary and not sure how to find and subscribe on their phone, go ahead and take their phone in your hand and subscribe for them. And add another few of your favorite podcasts to their list to get them started. They'll thank you for it. You can also find episodes of the show on our website, which you can find at zrgpartners.com/leadingvoices. And if you have comments or discussion about this episode or Leading Voices in general, or if you're seeking help in real estate human capital solutions, recruiting or consulting especially, please contact me at mslepin@zrgpartners.com. Thanks for being a listener to Leading Voices.